Everybody claim they use AI. We use AI. Like different people can mean different things about AI. Data mining, pattern recognition, history repeated self-assumption is how traditional machine learning works. And because of that, you need a lot of manpower to help you find diversified alphas. Some of the larger firms, they have like 100,000 researchers globally. Their edge rely on exhausting human power to try to come up with new alphas, new ideas. I ask myself, what is my edge going to be? Am I going to replicate the second generation quant business model, or I'm going to build something completely new?
My guest this week is Renee Yao. She began her career at Citadel, then worked at Millennium. Now, she's the founder and CIO of NeoIV Capital, a quant hedge fund with over $1 billion in AUM focused on using artificial intelligence strategies to trade the markets. In 2020, Business Insider declared Renee as among the leaders transforming investing in North America.
We're not relying on human power. Instead, our researchers are spending the time to develop the latest version of the AI system, so the system could automatically come up with new ideas for us. And more resources, that means like smart resources. Perhaps we could ask Google, now, with all the resources you have, why you haven't built ChatGPT?
Renee, thank you so much for doing this. You came from China, and now you're running and you founded your own quant hedge fund here in New York. It's a pretty crazy story. How'd that happen?
Well, that's a good question. So, as you can see, I was born in China, and when I was like 5 years old, I went to visit my uncle, who is a member of the Chinese first generation supercomputer research team member. So when he showed me the giant supercomputer, almost the size of two huge rooms, that has set up my early interest in hardcore science, like math and computing science. Later, I came to study States, and I studied at Columbia University. Same to you. After graduation, I on my third year of my PhD study, I got a call from a recruiter asking if I'm interested in talking to one of the top hedge fund. So I asked her which fund it is, and she said it's Citadel. So that was back in 2009. So that's how I started my career on Wall Street. After that, I joined different firms on Wall Street, become PM, become a portfolio manager, and then in 2015, we launched the new Ivy.
It's ridiculous. I'm curious. So what year did you join Citadel again?
2009.
2009. So that was right after the financial crisis. And now famously, a lot of hedge funds are down. I think Citadel was down, and there's that story of Ken Griffin. I don't know if he said this, but I recall him saying that they were a couple days away, a couple months away from going under, and things were really bad. What was it like joining after a time like that? And what are some of the things that they stress that, I guess, what are the things that you learned from them about risk management that you've later applied to Neo Ivy?
So that's a good question. Yes, that's definitely some very stressful time in the growth path of Citadel. So the painful lesson that Ken Griffin learns is they need to have a diversified strategy. So that's what I learned as well. So from Gordon Collins, which is kind of the Bible of active portfolio management, you know that every manager, their performance can be evaluated into three parts. Number one is, what is your edge? Number two is, what is the breadth of your edge? And number three is like, what is the constraint in your edge? So the breadth of the edge basically talks about diversification, right? If you have only one strategy, you're trading only one region, that's obviously make it less resistant compared to if you have multiple strategies, different frequencies, different horizons, and then you're trading different regions. So that's the point of kind of diversifying strategy and enhance the breadth of your edge.
Now, I'm curious about that. So you've talked about breadth of your edge and edge in general. So with regards to breadth of your edge, obviously at Neo Ivy, you're a much smaller team than, these large multi-managers or these large systematic hedge funds. How do you use the resources you have to execute multiple strategies and be fully diversified when I guess you have a lot less manpower to find all of these different, let's call them, independent sources of alpha?
That's a very good question. I'm happy to elaborate a bit more. So nowadays, artificial intelligence started to become the buzzword, right? Everybody claim they use AI. We use AI, and However, like different people can mean different things about AI, right? So if you think about the history of machine learning is actually a very broad subject. It's just like math, right? It can date back to 1950s. The very elementary machine learning can be like back in 1950s support vector machine, random, or like even like logistic regression. And later, as the technology evolves, there's more sophisticated approach like random forest, artificial neural network. But all of that approach, they fill the same learning methodology, which is you're training the computer with a lot of historic data, and you hope the model will find some patterns in the historic data, and you hope the same pattern will still hold in the future. So that kind of data mining, pattern recognition, history repeated self-assumption is how traditional quant, traditional machine learning works. And because of that, you need a lot of manpower to help you find diversified RFS, right? So that's why if you look at some of the larger firms, we call second generation quant firms, you will see they have like 100,000 researchers globally, right? In other words, their edge rely on exhausting human power to try to come up with new RFS, new ideas. So when we came out, I kind of asked myself, what is my edge going to be? Am I going to replicate the second generation quant business model where somebody else has already been doing for the past 20 years? Or I'm going to build something completely new? And so we decided to go to the second route, which is we're building an AI business model. Now, the difference of what we do versus the second generation quant business model is we're not relying on human power, because the difference between modern AI versus what we talk about, like historical traditional machine learning, is the model is supposed to learn and adjust itself in real time. It's like a human. That's why we call that artificial intelligence, right? Because think about when you teach a newborn baby how to eat, how to walk, you don't throw the baby with millions of historic data, right? Instead, you show the baby some examples, and going forward, the baby will learn through this analytical thinking approach. And that's how the AI algo learns. And it's not a static model anymore. It's a real-time learning, we call it self-evolving model. So that's why modern AI, is superior compared to traditional machine learning. So that's the foundation of our business model. So we're not trying to exhaust human power. Instead, our researchers are spending the time to develop the latest version of the AI system, so the system could automatically come up with new ideas for us.
Now, have you noticed, I guess, more improved? Because, you've been at this for 10 years. And when you talk about, AI that improves itself, what comes to my mind first is generative AI with all these different transformers. Because, I guess when you're taking in text data, or at least, I mean, just from my mind, I can imagine, let's call it a grok or some type of agent doing that. But you've been at this for over, for 10 years now, or for over that amount. And so I'm curious, what, now I understand if you can't fully answer this, but what type of features do you, I guess, make the models, the AI models that you're training, what type of features do they take in so they can continuously adapt to new market regimes?
That's a very good question. So the key point here is you should let the model identify the features themselves, instead of you as a human researcher tell them which features you're going to use. Like for example, traditional machine learning also use features, right? And the features they use are mostly linear in nature and mostly only associative in nature. Like for example, if we want to use kind of a model to forecast whether New York is going to rain or not, and we observe never rains, my neighbor's grass gets wet. Grass getting wet and rain has 100% correlation, so your traditional model will tell you, hey, this is the perfect feature. Let's just use grass getting wet to predict the rain. But we know it's not causative, right? So in our AI algo, it actually won't use that. So we're only looking at nonlinear ones, and we're only looking at causative ones versus associative ones.
Interesting. That's a good analogy. So, in summary, I guess this boils more down to the business of Neo Ivy. What do you know that the major hedge funds do? Because what you've told me is, these large, the previous firms you worked at, they run, let's call it a human strategy. I mean, obviously they run a bunch of other strategies, but really the main operational strategy is you get the highest, the highest talent people, the smartest people. You give them all this infrastructure. You give them, all this nice office, and you tell them find alpha, and if you don't, then you don't. And so, given that they have all these different resources, why can't they do the stuff you do? And what do you do that's different? What do you know that's different?
That's a very good question. So basically, there are three barriers to entry in this AI computation. The first one is you need to have an in-depth understanding of the difference versus traditional machine learning versus modern AI. And that will actually get rid of 80% of the competitors, because most people in their mind, their AI is just traditional machine learning. So the in-depth understanding of how modern AI works is the first barrier to entry. Now, the second barrier to entry is actually infrastructure. And what you've described, like a legacy firm with like 20 years of infrastructure, is actually not an advantage, it's actually a disadvantage. It's like a New York subway, right? When you have the New York subway system, which was the most advanced 100 years ago around the world, nowadays, if you want to build something new or want to upgrade it, it actually costs even more versus if you build something completely brand new. So think about the infrastructure side. 10 years ago, when we go to a computer store, we say, hey, we want to buy a laptop. Then the sales will tell us, hey, what about this dual core? What about this quad core computer, right? And that was the latest technology back then. Nowadays, you not only have CPU, you also have GPU, right? Like 5 years ago, GPU was just only used for graphic displays, right? But now, like, look at how much NVIDIA is worth because of they were successfully applying this into the computational world. And not to mention all those latest hardware designed by Google, by different kind of universities, which were specifically used for AI calculation. All those things doesn't exist 20 years ago. So all the infrastructure those legacy firms built, their entire infrastructure is called sequential-based infrastructure, which means they rely on purely CPU machines, and each machine has to wait for the previous machine to finish doing its own job in order to continue. So like everything has to be a sequential way. Now, the infrastructure we build is called a parallel distributed computing system, which means everything is parallel distributed and everything is fully automatically like parallel distributed. So think about the example of Renaissance building like their supercomputer, their physical supercomputer back in the 1990s. And that was a very fast supercomputer back then. I think it almost compete with the US Navy's supercomputer. But nowadays, even they gave up that approach because they know that's not a sustainable route. Everybody's free shift to the cloud, right? So the fast development in the hardware space and the ability to kind of integrate your latest technology into your AI simulation, how to build your infrastructure, is kind of another barrier to entry. Now, the third one is the in-depth understanding of portfolio constructions. Like, how do you evaluate risk, right? What kind of returns you want to deliver to investors? Now, when we talk about return, there are actually different types of returns. For example, there's total return, and there's beta return, which means you can just buy SP, right? Or you can just buy factors. You go Vanguard and say, I want to buy Vanguard momentum, I want to buy Vanguard value. That's factor return, or that's beta return. And there's also like pure alpha return, which means everything is purely idiosyncratic, it's non-correlated with everything else. And obviously, compared to three, the alpha return is the most scarcity and most valuable one. However, most of people, because they're doing the same methodology, they're using the same methodology, traditional machine learning for the past 20, 30 years, it makes their alpha not unique, which makes them in the business of crowded trades. So they're not in the idiosyncratic return business. Instead, they're in the crowded trade business. So those three barriers to entry are the reasons why we haven't seen a lot of successful stories in the space we are in.
Fascinating. And what the third thing you mentioned, I find very interesting because obviously, um, whenever people talk, I mean, when there's the classic news reporter asking, let's say a hedge fund manager, or, talking about Citadel or Millennium, and they say, the Nasdaq did 30% this year, and Citadel only did, let's say, 20%, or, like just this little discussion or debate. The normal answer of, let's say, a guy in finance is that, okay, yes, but we're independent of that. But you've mentioned something very interesting, which is that, maybe they are independent of the movements in the market, but if all the big funds are earning the same strategies, you you're not, or it's not exactly free of risk, because we've seen with the quant quick in '07 that, things can get crowded, and things can go wrong. Um, One of the other things that I am curious about that you did mention, albeit briefly, is expertise and talent. Because you mentioned three things. Um, and the first thing you mentioned, I believe, was that uh, you at Neo Ivy, or I guess, just any firm that specializes in one thing, and you're specializing in artificial intelligence for the market. Um, so you said that you have a talent advantage. Now, for me, that just sounds like, I find that difficult to understand, because these guys have all the money. Surely that means that with all the capital concentrated, I think their AUMs are, the tens of billions of dollars and approaching 100. How can they not have a talent advantage if they can just throw, let's call it $50 million here, at 10 million there, at an AI researcher? I'd love to hear it from you.
Sure. I mean, that's actually a very good question. Perhaps we could ask Google now, with all the resources you have, why you haven't built ChatGPT, right? So sometimes, yeah, more resources doesn't mean like a smart resources.
I see. I see. Okay. Okay. Understood. Now, I want to gear our conversation more towards you starting the business. Because obviously, you've been at Citadel, you've been at Millennium, and you've ran, you worked as a quant researcher, you've seen the entire pipeline, and then you ran your own book at Millennium, and then also at another prop trading firm. What are some of the differences between what you were doing there and actually setting out and starting your own fund? What were the differences?
Sure. So I think the main difference are what type of returns we're trying to generate to investors. Like in those big firms, because of their size, it makes them impossible to try to focus on like pure alpha returns. Because alpha is the most scarcity in the entire market, right? You cannot just find like 50 billion or 500 billion of alphas in the market. Majority of the returns actually comes from beta. So those firms are forced to kind of explore the beta return perspective, and thus put them into the quality trade like business. Now for us, because of our unique approach and because of our like limitation in size right now, it's actually an advantage for us, because everyone knows that size is the enemy of returns, right? If a strategy can run successfully at 500 million, it doesn't mean it can run successfully at 500 billion, right? So size is the enemy of returns. Now, because we're still relatively small, that enables us to harvest some of the most scarcity returns in the market, and thus really maintain our independency and non-correlation.
Interesting. And so when you started, how were you able to focus on that and also building the business? Because I imagine that when you're starting a fund, you're trying to raise money, and then you also have to build all this infrastructure, then you also have to hire all these people. What was that experience like?
It was definitely very busy. Like it's never easy to be entrepreneur. I think we all understand that. And running a business as a hedge fund manager is different from running a portfolio manager when you work within a platform. So that is something that I definitely learned throughout the experience. And if I have some kind of lesson to share with, fellow entrepreneurs, and so they can kind of learn from my experience, and hopefully they will, they don't need to go through the same detour I went through, is you have to kind of learn to focus on the things that the most important, and just allocate other jobs to different people. Like quite often, entrepreneurs want to do everything by themselves, and that will obviously become a distraction for the main focus where they should be. But if you have ability to or resources to allocate the jobs into different people, and so that you could focus on the things that are most important for your business, then that will be much more efficient if you do everything by yourself.
What for you has been the biggest constraint as a startup fund? Back in a couple years back, what's been the biggest challenge?
I think for us specifically, the challenge is the sophistication of the model. Because quant traditionally has this reputation of, being a black box. So most of quant managers, because they're running simple quality trades, like which is mean reversion momentum trades, they don't like to explain what they're doing. Of course, if they say I'm running momentum, I'm running mean reversion trades, nobody would hire them, right? So typically quant will say I run a black box. I wouldn't be able to tell you how my model works. And that kind of shoot them back in the foot because the investors need clarifications, right? And like even for us, like normal people, we want to understand if we want to buy something, we want to understand more of how this thing works, right? If you buy a car, you want to try, you want to see how it works, versus someone say, hey, just go ahead and buy and don't ask. So that has been kind of a stereotype when people talk about quant managers. And AI is even more sophisticated than quant, right? So this is a very sophisticated strategy, so investors aren't so familiar with. Right now, of course, everybody sees how powerful ChatGPT is, so I don't need to explain how powerful AI is. But 10 years ago, that wasn't the case. So I need to explain why AI is superior and why we think this makes sense, make it better to apply it in the financial market. And that takes a long educational process. So I think that was the biggest kind of constraints, like specifically for our model.
And so, how do you deal with that sophistication when artificial intelligence? Maybe not every trade is fully interpretable. Maybe it's difficult to understand. Or, maybe the regime is different. Like, what if you've trained your model on all this data from, let's call it before 2020, and, COVID hits, and all of a sudden, all these retail guys are piling into all these different stocks, and just the market's just shooting upwards. And maybe your models aren't used to dealing with a period like that. What do you do, and how do you make decisions in those, I guess, moments of uncertainty?
That's actually a great question. And that's highlighting the difference between how AI approach versus traditional quant approach. Because like you said, I'm glad you mentioned COVID. COVID is really a perfect example to show if a manager is using model AI or use a traditional quant approach. Because if you're using traditional quant approach, then like we described earlier, you're learning methodologies from historic data, right? And you hope the history repeat itself. So unfortunately, COVID is something unprecedented. So you don't have something like that in the history. And so of course that poses a fundamental challenge for anyone who's trading traditional quant approach. Now, that's why in March 2020, when the market was crashing 30% in 1 month, that was a nightmare for a lot of the traditional quant managers. Now, for us, the AI models, they're supposed to learn in real time, right? They're not supposed to learn from historical data. They're supposed to learn in real time just like our human does. So our AI model will be able to quickly adjust itself and update itself accordingly. So that's why we not only delivered good returns in March when the market was huge sell-off, we also delivered good returns in April when the market rebound. So that shows how smart AI algo is. And that's a self-evolving algo instead of a static model.
Fascinating. Um, I still, I guess one of the things that you've mentioned there over and over again, or it's something you mentioned, it's the traditional quant approach versus the modern AI approach that you guys have at Neo IV. What are some of the modern tools that you've been using? And if you can't answer this, that's completely fair. But what are some of the modern tools that you've been using that you think have given you, tons of value for the trades you've been putting on?
But there are tons of AI models out there, right? Like we have, like 10 years ago, we have RN model, we have RSTN. Nowadays, we have like say transformer model. I mean, even the AI itself has been going through like versions of evolutions to make it smarter, more efficient, right? So we use all of that. It all depends what kind of the problem you're trying to solve. And so the AI model will automatically find the proper like solutions for it, instead of say me sending researchers say, hey, this problem we need to use transformer model. That's not how it works.
Interesting. I want to go back to you starting, the fund. Um, when you were, first getting started, and I guess I want to hear more from the infrastructure side. Did you build all the infrastructure from scratch? Did you consider, I guess buying infrastructure? Because I guess when you transition from from a hedge fund like Citadel, when you have all these different tools, it can be difficult to build up, the same level of infrastructure. As you mentioned, a better infrastructure. How was that like?
Yeah, so that's exactly why we build our own infrastructure from scratch, because the old sequential based infrastructure wasn't able to support the sophisticated calculation needs of modern AI. So that's why we actually build this modern supercomputer-like infrastructure from scratch when we launch. And throughout the years, we gradually add more kind of sophistication to it. Like for example, when we first built infrastructure, it was just pure CPU based. But then through the years, we added GPU, we added TPU. So now it's a very sophisticated modern supercomputer-like infrastructure.
Awesome. Your story is crazy. You moved from China to America to the statistics masters at Columbia, and then you're doing your PhD, and you got recruited by Citadel. We're going through a period of time in the world today where there's so much change, and a lot of young people and people I know that are very intelligent from my undergrad that are really struggling to find jobs. They feel like even though they've studied very hard, even though they have a skill set where they've really worked hard to develop, maybe they're very good at technical problem solving, it feels like there just aren't enough good jobs for everyone. And I guess it's only for the exceptional performers that thrive. I think we're living in a world today that very much revolves around power laws and winner take all, where the largest companies get almost all the value and the top individuals get almost all the opportunity. What advice would you give to someone who's maybe not there? Maybe they're smart, right? What advice would you give to, let's say, the 70th percentile math undergrad in the US or UK or China or India or the Philippines? What advice would you give to them? How would you navigate trying to find opportunity today?
Well, first of all, that's not politically correct, because according to our president, we are the best history of best economy since the net tools can build. Anyway, but I mean, the challenge has always been there. Like even in the when the period when economics are good, when the periods when economics are bad. I mean, the challenge has always been there, right? So what we can control is, first of all, know what you want to do, right? Know what you want to achieve. Do you want to be a quant? Do you want to be an engineer? Do you want to be a nurse, a doctor? First of all, know what you want to do. And second, once you set up your goal, you go for it, right? You put all your effort to realize your dream. And someday it will happen, because all those effort will accumulate and and all your dreams will come true one day.
Wonderful. I guess what I would say to that is, what if my dream is what if my dream was to become a blacksmith just before, I guess, factories were coming out? Like, what if what I aspire to become is not timed correctly for what the market needs? So let's say I want to become a consultant, and we've all seen the stories of consultants, essentially getting ravaged. I think junior jobs are down like 80%. I think I heard that statistic from a friend of mine who works at a consulting firm in London. Um, and so what if that's my goal? A goal like that just there's the number of opportunities are just shrinking and the market for that is dying. How would you navigate that? Should we all aspire to become top researchers at OpenAI, or what do you think the world needs um young people to do today?
Well, things are definitely changing today, right? Like the type of jobs, the type of techniques, talents we need, skill set we need today are definitely different from the skill sets that we need, 20, 30 years ago, right? So, like, even for us as human, we need to kind of learn to adapt to it, adjust to it, right? Versus if you keep the same drink for the past 200 years, right? If you want to be a blacksmith 200 years ago and today you still want to do that, the market's definitely changing. So nowadays, yes, because of the challenging application of AI in all different kind of fields, there will be some jobs that are at risk because the cost of applying AI is much lower than hiring like a human. So you need to adjust yourself and ask yourself, is my dream in my best interest? Right? So once you kind of do the analysis that way and you find a good answer for yourself, then you go for it.
100%. It's there's a lot of risks now and a lot of things you can't see. So, I agree. You do have to reflect on that deeply. As part of what you do all the time is at managing money is you're taking calculated bets essentially, right? You're always having to make decisions without all the information. Have has all this trading and researching and thinking about the markets, which is a very chaotic system, has it taught you, are there any lessons that you found to be analogous to life that you think the everyday person, that you think the average person can apply those principles? That you think the average person could apply to their own life as principles?
Yes. I think for trading and for anything else, I think it's very important that you set up the rules, or in other words, you are disciplined, right? If you want to do like pure AI approach, you want to deliver pure alpha returns, you stick to it, right? Because there will be times other things are tempting to you. Like for example, when markets are one way up, everybody goes to the beta bet, right? And of course, buying SP and sits there, like for example this year, right? Buying Nasdaq and sits there generate you 30% returns. Versus like for all the effort you put in, you might not be able to beat Nasdaq. Sometimes you might question yourself, am I doing the right thing, right? But if you are disciplined and you know what you're trying to do and you stick to it, and that's a value that you provide. So that's kind of the lesson I learned.
Interesting. Yeah, I agree. And I think that nowadays, because there's so much noise on social media, on YouTube, like let's say I was focused on becoming, let's say a quant, right? And then I see all this AI research stuff, and then I see these guys making money, doing, doing these like businesses online, using automating processes for small businesses. I think nowadays we're in a period where there's so much noise that it can get extremely, extremely difficult to stay focused and disciplined on one thing. And I think, Renee, that you are someone who clearly is very, very disciplined at staying focused on one thing and doing it exceptionally well without much noise. I mean, I look at your career. You did the stats masters at Columbia, and then into a PhD, and you were very much focused and applied that skill set at Citadel, and then at Millennium, and then started your own firm. So I think you've approached things with a lot of discipline, and you've never really veered. I mean, from what I can tell, you haven't veered off and said, "Hey, I wanna start automating processes for a small business because there's a lot of money there." And I think that nowadays it's just so easy to get distracted with all these different things. Have you had to, you know, I'm sure you've had to say no to a bunch of different opportunities. How do you make sure that how do you stay obsessed about the game you're playing? Because obviously, running a fund is not always easy. I'm sure you're down on some days, or something's broken, and there are tireless nights. How have you maintained that obsession and passion for managing money and trading?
So that all goes back to when you think about what your goal should be, right? So when you decide what you want to do, you need to do a lot of research. You need to think very carefully about what I want to spend my time. And once you decide your goal, you go for it. So that's what I did. I have my passion in AI. I have strong beliefs that if I successfully apply AI in financial market, we will bring like a different era of how to do quant trading, like different from the second generation quant. This is the third generation quant, and everybody will see that. So we have the strong belief of that approach, and so we've been putting our effort into applying that into our trading process, and we've been doing that for the past 10 years, generating really uncorrelated returns compared to all those traditional second generation quant funds. So that tells something. So that's why I think dedication is very important when you're pursuing your dream.
100%. And I think that's a great place to leave our conversation. Thank you so much for taking the time to do this interview, Renee. I really appreciate it. And I love the lessons you shared about the markets and about life. Thank you.
Thank you. My pleasure.